Hey, everybody. As we head into the end of 2022, I can't help but feel we are living in a very dynamic, changing, and really confusing time. And from a gaming startup's perspective, or from the perspective of those who are thinking about starting a new gaming startup, I think there's really a lot to think about. IDFA deprecation, global recession, and the macroeconomy, the decline, at least for the moment, of crypto and Web3, stock markets tanking, and the potential impact to VCs and funding. And yet, on the other side, we have more opportunity than ever with globalization, the growth of countries like India, the growth and engagement that we're seeing in PC games, hitting all-time highs on Steam, for example. And we've also got things like ChatGPT and generative AI presenting potentially new opportunities. China resumed new game licenses, and we've got a lot of things happening. So, in the midst of what is likely to be a new environment for gaming startups in 2023, I brought Jason Chapman from Konvoy Ventures and Josh Lu from a16z and Andreessen Horowitz to help us sort through this, at least for me, what is a very confusing time. And I thought we could start just by having you guys introduce yourselves. I know you guys are probably famous in your own right, but for our audience, it'd be great to hear more about you. Maybe starting with you, Jason.
Yeah, man, maybe Josh is famous. I don't know if I could claim that myself, but in this very specific sphere, maybe a couple people know us. But yeah, at Konvoy, we focus on the infrastructure, platforms, and technology of games. We tend to avoid direct studio bets, just kind of our background and what we like to focus on. We typically do seed and sometimes Series A deals. We tend to like to lead a lot. So we lead about 80% of the transactions we do. And we invest globally, except for a couple of geos. Russia and China are the two that we do tend to avoid. But we've been in the space since 2018, and we are on Fund 3 and having a blast allocating to this great industry.
Nice. Josh?
Amazing. I can talk a little bit of the fund. I can talk a little about me. A16Z's Games Fund. We're new. We just announced this year, and we invest in the games industry broadly, studios, and sort of everything else adjacent to the games industry. We really care about sort of supporting the industry going forward. New fund, so we're still growing. I think there's about 11 people sort of full time on the fund at the moment. A little more than half of that are investors, and I'm like one of the newest investors. So I'm a baby VC in every way. I came up in the games industry as a PM and a GM at places like Playdom Disney and Scopely, where I was the first employee, and Zynga when we transitioned from Facebook to mobile, and Blizzard Entertainment. And then I did a stint at Meta, but I really missed the games industry. So now I'm back just this time as an investor.
Awesome. So I thought we could just kick it off by starting with the question that I think a lot of startup entrepreneurs or gaming entrepreneurs are interested in, and that's like the current funding environment. There's kind of the word on the street is that things might be down. And so in terms of the current state of funding for both of you, what do you think generally in terms of like the general environment and kind of valuations? How have they been impacted? What do you guys think?
Josh, do you want to start this off, and then I'll hopefully round us out here?
Sure. Sounds good. Well, take everything I say with a fistful of salt because I'm new, and so I wasn't here for some of the good times. I will say that, at least for us at Andreessen Horowitz, we're still actively investing. We continue to see really great teams come out for fundraising. Great founders don't really control, timing, especially, teams that are sort of just coming together now. And so we are actually seeing some really great teams come out. We're continuing to invest in the games industry. As far as valuations go, I do think, there's a lot of uncertainty more than anything. And so as investors, one of the things that we're thinking about are, for early stage investments, how do we work with founders to maybe support them a little bit more early on so that they have a little bit more runway through, maybe some uncertain times ahead. So sort of front loading investments early on and, allowing sort of founders to just go to work and not have to worry about fundraising for a while. And I think the other thing as it relates to uncertainty is, there are certain signals that are still really, really strong even during uncertain times. Quality of teams. Have teams shipped games before? Have they? Do they have some expertise in the exact genre? Have founding teams worked together for a long time and have seen some crap together? These are all still really strong signals that still make for really great investments into teams.
Yeah, I think I echo a lot of what Josh says. So trying to add net new here, I can definitely attest. A lot of groups have paused or are not allocating. Thankfully, Andreessen and us are not in that camp, and we are active still today. But I think you're going to see a continued pullback in 2023. I think it's going to get a heck of a lot darker before it gets brighter. And so, us internally, we sort of have the hypothesis it's not going to start kind of dipping out of this. We're going to call it a dark recession or dark period for specifically the private markets and funding until probably Q2 or Q3 of 24, right? And so, what is that actionable for startups here? You need to be thinking about that is the fundraising environment you're raising into. So that's one. Two, when it comes to just kind of the deal activity today, right? Just some kind of numbers. At the seed level, it remains roughly unchanged year over year. So we track on a quarterly basis number of gaming deals done per quarter. So in Q3 of 21, which is obviously the last quarter, we have Q3 data for 2022. 76 deals were done in 21, 77 were done this year. So roughly unchanged. At Series A, that's down about 15%. At Series B, it's down about 47%. And at Series C, it's down about 67%, right? And so what you're seeing is there's a massive plummeting at the late stage, which isn't uncommon. And then it eventually does cascade to the earlier startups in the ecosystem, or earlier companies raising in the ecosystem. We think seed and Series A will probably be the two that are most unaffected by this over the next 18 months. But those are kind of some numbers just of what is actually happening. And it's because a lot of people, especially at growth stage, are a little skittish, and rightfully so, right? When things are uncertain, investors also pull back. And unfortunately, that does impact the fundraising environment for startups.
Right. So Jason, the kind of decline in the later stages, do you think that's directly attributable to just like the current performance of the public markets right now, or what are you attributing that to?
Yeah, a lot of things, right? So when you're doing a growth stage deal, right? Let's call it B and up, right? That's typically when you start to think about growth. B, C, and D rounds. You're looking at what is the likelihood for this company to continue raising money, right? You have to think about that as you allocate. And it just became a heck of a lot harder for a company who's raising a B round to go raise a C round, right? And so a lot of groups are often choosing just not to raise, right? So this is a two-way street. Startups are looking at this being like, I don't want to raise into that environment because I know I'm going to get hit on valuation a lot harder than I would have been, 12 months ago. So that's one. The other thing that's happening is that a lot of those growth stage groups are the ones who've been impacted the most by let's call it the chaos in the publics, right? And that is then cascading to them, which then eventually does cascade to early stage, just not as much. And the reason is because, we could talk about valuation decreases, and we're seeing roughly at seed about a 40% pullback in valuation, at Series A about a 55% pullback.
Wow.
You don't have that much more room to compress though at seed, right? Eventually you can't compress much more than we're already seeing. You can't go back to like, I'm raising at 2 million posts. Like, I don't think we're ever going to go back to that environment. Like, companies do need money. And cost of living is what it is. So anyways, that's where we sort of see seed being the most insulated, Series A kind of an extension of that, and Series B and Series C really getting impacted the most, which is evidenced by just the fact that there's so many less deals being done at that. Like there's 11 done last quarter. In 2021, same quarter, there were 21 deals done at growth, right? So that's a huge pullback. So I don't know. I said a lot there, Josh. I don't know if you want to fill in the gaps on anything I missed, but.
No, I think that's totally right.
Well, what do you guys think about geographical differences? Because it does seem like, at least anecdotally, I'm sitting here in Bangalore, India. It seems like a lot of the local VCs here are not only trying to deploy, but that valuations still seem healthy relative to potentially like the global market? Do you guys think there might be some geographical differences, or again, I'm operating off of very few data points.
Yeah. So, when you
I
say
can start.
when you say healthy, just before Josh starts, do you mean healthy for startups? So like higher valuations for startups, or do you
Higher
think
valuations for
healthy?
startups.
Okay, got it. Sorry, Josh, go for it.
No, I was just going to say, I think there probably is a little bit of geographical difference, but I actually think it has more to do with maybe just like how much dry powder there is. One maybe not talked about thing is that there is actually quite a bit of dry powder in the games investing space at the moment. There have been a couple of
Mhm.
funds that have raised recently, and they have to deploy at some point, and so despite all the uncertainty, there are still investors out there who are looking to invest in companies. And so maybe what you're seeing a little bit is a flight to quality, where maybe there are fewer net deals getting done, but higher conviction deals that are then getting supported with larger valuations. Is one potential explanation.
I see.
That's 100% right. I mean, looking at how much has been raised, even this year alone for gaming, funds, us included, right, in this conversation, Konvoy and Andreessen, looking at, over $1 billion has come into, fresh dry powder for the gaming industry, right? And that number is increasing, right? And it's because it's a great industry throughout a recession too, right? There's a lot of talk. A lot of people say like gaming is recession proof. I don't think that is totally true. I think it's recession resilient. If you look at it, I think there's a lot of uncorrelated stats to how gaming performs in a downturn. But going back to your point specifically on geo, just some interesting stats. Almost all the deals in the last quarter were done in Europe, Asia, or North America. Almost nothing in South America. I think $1 million was raised in Africa last quarter, and then Australia had, I think, one raise. So honestly, there's been very little activity out of the core markets, and so I do think it becomes harder in those, let's call them fringe or new developing markets, to raise in this time, because again, as Josh said, 100% flight to quality, and also the risk tolerance for a lot of funds goes down, right? The risk tolerance for, I want to swing at a pitch in Uruguay versus in, let's pick a market like Finland, right, which is a well-established games market. The tolerance is higher for that sort of risk tolerance, right? I'll tell you our approach to that, and I think Andreessen shares this approach with us, is we are risk on. We think these are the times when you move, and this is when you separate yourself from safety, and it's hard to do that as an investor in a downturn, but that's what you have to do, I think, to be a top performing fund.
Okay. And maybe go ahead, Josh, please. Go ahead.
Yeah, I think all of that's right. And then maybe just one extra thing for India specifically. India
Mhm.
is, of course, a massive opportunity, and it's also, as a gaming market, undergoing a whole bunch of change at the moment, structural
Yeah.
change that makes it, I think, pretty interesting for investors to be investing into companies right now. Between sort of the explosion of mobile and access to data and some of the geopolitical stuff with China, you're seeing, I think, quite a bit of change, and change leads to opportunity.
Got it. Maybe I could ask a potentially sensitive question, just kind of like rumor mill, overheard as a rumor from a venture partner at a venture firm, that what may also be impacted are the venture firms themselves, and that capital calls may not necessarily be honored. Can you guys speak about kind of like some of these rumors floating around, on the street?
Yeah, I can take the stab for us here. Looking at LP defaults, which is really what that is, and a lot of people kind of look back to the last recession, or even sometimes in COVID. Even though that wasn't a recession by any means, when times are tough, what happens to your sources of capital? There's kind of a couple things that weigh into this. One is, who are your LPs, right? There's kind of a couple profiles of LPs. There's institutions, there's large asset allocators and fund of funds. You've got private money from individuals and families. You've got strategics in gaming that invest, and all those are impacted differently by public turmoil, but all of them are impacted nonetheless. A lot of people discuss this, and I'll say one, LP defaults are extremely rare, right? Like they don't usually happen. What is more common during a time like this is the LPs pay more attention to the speed of allocation. And so in the last cycle or last couple of years, people got away with a lot of things like we're going to allocate 40 or 50%, and we're going to allocate our fund in 2 years or under, right? A lot of people did this. And I'll tell you, looking back historically, you typically look at an allocation period of around 4 years, maybe 5 years. 3 would be very fast. I think we're going to cascade back towards longer allocation periods. And so less funds are going to be allocating their entire fund in 2 years, right? I think that's one thing that's going to be impacted. The more common thing that I'll tell you, us at Konvoy have not experienced, but talking to obviously a lot of other GPs in the industry, what is common is an LP group will talk to their GP and be like, hey, it'd be really great if this quarter you didn't call above this. That would be really ideal. That is the way that they kind of cascade and put pressure. And that is also, and that mainly happens at later stage, right? With the large asset allocators where they're saying, and that's another thing that cascades into why people are allocating less, right? Funds are less eager because LPs are less eager. Startups are less eager. Pretty much everyone is less eager, right? And that's kind of the situation for LP defaults. People like to say this, but I think the number that I've seen is, less than 1% of LP commitments defaulted in the last recession. I don't have a source on that, so you can't hold me to it. But that is the number that I'm remembering.
Right. But to your point, it's more of an like informal, soft kind of slow down type of situation, most likely.
It's kind of like, hey, like, don't do that to me, right? Like that's like more of the discussion, because that would put me in a tough spot. Because the reality is if an LP defaults, it's a pretty harsh repercussions for that. A lot of times they actually sacrifice their interest in the fund itself. Again, we have never experienced this or gone through this 3 funds in. But those are pretty extreme scenarios, and most managers thankfully do not have to deal with that.
Okay. I was thinking maybe we could also talk about sort of the opportunity landscape, and I think there's a lot of talk in the industry about, is mobile dead, the opportunity in mobile versus maybe PC or console gaming investments. Josh, I know you're kind of looking at a lot of different types of gaming opportunities. Do you have a specific outlook for mobile versus PC console?
Totally. Well, you're going to get a biased answer because I came up in mobile games, and so I love mobile. Look, it's been a little tough, I think, for mobile the last year or so post IDFA. I think when I talk to lots of companies who have been in mobile for a long time, they're still figuring things out. One of the paths post IDFA, because privacy stuff has happened before to impact ad and acquisition markets, is companies have sort of come up with clever ways to sort of hack past it. That hasn't really happened so far, at least nothing clever. What you're seeing a lot of mobile games companies do is just shift their spend from iOS to Android, shift from places like Facebook to other networks, and that has had an impact on sort of like acquisition performance. But I did see, I think Deconstructor of Fun took a sort of mobile outlook thing, and they showed that although IAP spend was down in the first half of 2022, mobile downloads were up. And what that says to me is that, some of the sort of like cyclical metrics are down. IAP spend is down because of things cyclical, either acquisition or targeting or macroeconomy, people spent pulling back on their discretionary spend, but downloads are up. And if you've ever run a game before, in live ops, you'll know that monetization is like the easiest metric to move. And the ones that are structural, i.e. downloads/growth and retention, are the ones that are really hard to move. And so that actually tells me that the intrinsics of the mobile gaming landscape are actually still quite strong, and so I'm still a big believer in mobile. But in my role at Blizzard, one of my learnings is we launched a game called Diablo Immortal, which was a mobile PC crossplay game. So when you think about crossplay, in the past it used to sort of be like PC console, but I'm actually really excited about crossplay PC mobile for a whole bunch of reasons. And so I'm just really excited about companies that are playing in that space right now. So mobile is not dead. It just might be integrated into sort of a future platform agnostic strategy.
Okay. And maybe speaking of opportunity even further, I briefly mentioned Web3. It's kind of had a little bit of challenge recently. And so when you think about the opportunity for Web3 companies, are you guys still investing in blockchain-based games and crypto games? What's the current outlook on that side?
Oh man, this is a discussion for an hour in itself, I think, Joe. Well, it's saying it's been a tough time, I think, is a very kind way of saying it. I mean, at the peak in 2021, I think the crypto blockchain industry was valued around 3 trillion. I think it's now valued about 900 billion roughly. It's down about 2.1 trillion. I mean, when you lose that amount of economic value, it's hard not to look at that. And kind of going back to Josh's great point earlier about dry powder, 55 billion was raised in this year and then last year alone across blockchain funds. This is blockchain funds, not blockchain gaming funds. And a lot of that money has found itself into gaming, which has kind of inflated it into being the most expensive subcategory that exists still to this day. And those valuations are relatively still propped up because of all that dry powder that's still sitting there with those funds, right? So, looking at Web3, I'll tell you, our last deal in Web3 we did was in, I believe, October of 2021. And we as a firm decided to not launch a product dedicated to blockchain gaming, right? This was a decision that we made as a firm, that we were less inclined at this time, and it was mainly driven by the player base size. Josh talking about mobile downloads and just intrinsic metrics. The intrinsic metrics in blockchain gaming is there's about 10 to maybe 20 million people that play games that are enabled by blockchain. That's a pretty small number when you're looking at 3.2 billion people play video games, right? And so for us, we saw this as the most expensive category, the least number of players, and so we weren't as excited. So I know I'm sounding like a total bear. I got all that out of my system. Now my bullish side. I think where we're at with this is the metrics didn't match the funding interest here, but that doesn't mean that under the hood that it's all bad. And so we look at it and we think this is really great. Just like VR had a lot of false starts, I think blockchain gaming kind of had a bit of a false start here. And so for us, like, we do still consider it, but the bar is extremely high, and it's even higher than most because I think you look at this as it's just a small market to service, and so you have to be really special. So that's our general take on this. Yeah, and Josh, I'd love to hear your thoughts too.
Yeah, I think we think about things the same way. When we look at least gaming studios that are Web 2 versus Web 3, we actually take the same exact criteria. So we don't treat sort of like Web 3 studios any differently. The bar is similarly high across both Web 2 and Web 3 games. And the bar is already very, very high for Web 2 games. So I'm not saying that because the bar is lower. The bar is actually quite a bit higher. And so when we look at Web3 opportunities, we're really looking at the exact same signals that we would look for in really strong Web2 studios. Again, strength of team, strength of opportunity, speed of execution, all of the things that you would expect and in a really great Web2 investment, we look for in a Web3 investment. And then maybe the added sort of filter that is useful is, because so much money has poured into Web3 games and because there are so many projects, there is a war for talent. And so one of the best signals that we've been able to look at are, hey, for people that we know have shipped games before, which ultimately in any sort of game company is the most important thing, is like, can you ship a thing that people love? We really take a close look at the founding teams and see whether or not they've been able to recruit well, people who have shipped successful games, people who have seen some crap. This is sort of the time in the industry where having some of those battle scars is really, really helpful. And so that's something that we've been focusing a lot for all studios, but especially for Web3.
Got it. And maybe like in this current environment, then, if you were to give any advice to founders or or new startups trying to raise funding, to your point, Josh, is there anything specific about this current moment in time? Does it really require a stronger team more than other times, or any other characteristics that you guys would be looking for in order to get funding from one of your firms?
Well, one of the things that I'll start. One of the things that we've been looking for are for founders to be really thoughtful about testing their ideas earlier and faster. I think there was a period of time where money came very cheaply, where founders felt a lot less pressure to sort of uh, put pen to paper and put uh, uh, code in, uh, and uh, and so we've actually been having a lot of conversations with teams that are out raising right now. Hey, what are you trying to prove between this raise and the next raise, and what are you doing to sort of make that cycle faster? What can you prove in chunks rather than as a fully fledged thing? And what are the clever ways that you can prove it along the way? It sounds maybe cliche and obvious, but scrappiness in game startups is just as important as scrappiness in the rest of sort of tech. That's not necessarily a thing that was maybe as emphasized in the last few years, but certainly founders who are already funded and are looking for funding right now have that on their minds.
Yeah, I think that's totally spot on. Trying to add net new. A couple of things that we do, and what it speaks to different investors differently, right? Like some people resonate with other strategies versus others, but in a similar vein, we tell our founders, hey, like if we're going to commit to a round, okay, so from seed to Series A, what's exactly the progress we can hold you to as your investors, right? And please do not show me your, really, really aspirational goals. Show me your realistic, like, hey, we're going to be happy at the end of this, right? And I think one of the things that founders often get wrong with, I'm going to say most serious investors, is that they think that the higher the number we can show in our chart of in 5 years we're doing 250 million in recurring revenue, Josh and I see hundreds, thousands of decks a quarter, right? We see so many opportunities. We know kind of what's real and what's not. And so speak to us in a real way and you'll get our respect, I think, a lot faster. And I think you'll get your investors to take you seriously. The other thing I'd tell you is I think a lot of people use their board really poorly during at just period. They use their board very poorly. I have found it really helpful with founders when they try to use us as sort of their accountability of, hey, I said I was going to do this. I either got there or I didn't. Here's why I didn't get there. Setting goals with timelines is very, very important. If you set a goal and there's no timeline attached to it, it's just a dream. Like it's something you hope you achieve at some point in your life. But holding yourself to that, I've found that is very helpful for operators, and it's very helpful for us too. And it's not like I'm sitting there at the end like, gosh, like you missed 3 of your 5 metrics. It's like, let's figure out why you missed those. So anyways, encouragement would just be set clear metrics, clear timelines, communicate that well, maybe pull back on the aspirational visions a little bit when it comes to revenue targets in particular, and use your board effectively. Those would kind of be my advice to kind of people in their seed Series A in particular raising right now.
Totally, and
Cool.
ask for help proactively. Like these are challenging times, and we as investors exist to help. And that's not just in introducing you to somebody. It's not just in being a sounding board. I mean, we really are here to help. So be proactive about it.
100%.
Got it. And I wanted to kind of ask more of a philosophical question. And it has to do with like a question that I've been thinking a little bit about, which is like back in the 1990s, venture capitalists used to talk about 2 different kinds of startups. On the one side, you have better, faster, cheaper, meaning companies that do roughly the same thing, but incrementally a little bit better. And then kind of these brave new world companies that are trying to do something extremely dramatically different, kind of like a quantum leap in terms of capability or function or cost or whatever. And when you guys think about gaming startups today, does this kind of characterization make sense? And do you see one versus the other? I'm just trying to get your perspective on this kind of question, whether it even applies to gaming.
Man, I mean, my mind goes straight to Brave New World. That's where my head
Okay.
goes, especially on the content and publisher side of the house. I'd say that's where my head goes. I think gaming. Rewind 20 years ago. What was gaming? What did gaming look like to what gaming looks like today? I mean, we're gaming on an astronomically new amount of devices. From VR, mobile, new types of consoles. I think that is evidence of where our industry sits. We're not just trying to do things cheaper and cut costs. I think we're trying to entertain the world, right? Like, this is what this industry does. It's the pastime of 38% of the world's population. There is no other activity other than drinking water and walking and eating, probably, and sleeping, that 38% of the world does, right? And this is where I think, when I look at what we do, and Josh and me and the rest of our teams, we're trying to fund the people that are forming new ways to entertain and connect and build community. And so that to me screams Brave New World, not faster and cheaper. Of course, there are examples of some great service providers in our industry that do those things, and that's great businesses. I'm not digging on that, but in aggregate, I would slot us in that explorer mentality versus the engineer trying to make things go from 1 to 5 to 1 to 3.
Yeah, faster and cheaper is. I think the answer depends a little bit on sort of like the underlying assumptions that you're making with faster and cheaper, right? It's like, if you look at the mobile games industry over the last 6-7 years, a lot of that story has been faster and cheaper. People trying to optimize their LTVs, their LTV to CAC ratios just by like 5 or 10% here and there, and that has built some really great businesses until some of your underlying structural assumptions change. When there are black swan events in acquisition and targeting, or in new platforms, or whatever it is, suddenly a lot of those really great optimizations go away, or the nature of those optimizations changes, and you sort of have to scramble. And so, to Jason's point, Brave New World is always the best way to sort of like build a moat, and it doesn't have to be expensive, right? Brave New World can be in not just in having these like massive AAA budgets, or spending a bunch of money or dev time against a thing. It can be an insight on distribution, right? Like when League of Legends came out, and people don't remember, they were competing against another title, Heroes of Newerth, and Han had a bunch of sort of like ex Dota people. It was a really strong team, and League of Legends, just their distribution insight was, well, let's make this thing free to play, and people thought they were crazy, but that is what ended up sort of like generating this massive generational game, and so this is all a very long-winded way of saying, we agree, Brave New World, but maybe one nuance is there are lots of scrappy ways to get to Brave New World that might look like you trying to make things faster, cheaper. It's just a paradigm shift in how you think about it.
I thought we could now start to talk a little bit about trends, macro trends, and I know, Jason, you had mentioned that games are kind of recession resistant. My own perspective is that the way that I look at the impact of like a recession on the gaming industry is that, like, well, if you have a premium game, that's fixed cost and you have a lot of value, and that the value for that game is really high, that that I think that kind of explains some of the growth in terms of the PC market, PC console market. Whereas IAP spend, you can still play. It's more kind of like a discretionary spend versus non-discretionary, which I think kind of explains some of the kind of loss in IAP spending and well behavior. But if we were to think about a potentially prolonged recession and that impact on IAP spend, do you guys think, does any of the sort of macro trend and the potential for there to be like a kind of like a prolonged recession, does that factor into how you guys thinking about investing or how you would advise some of your companies? How does this specific kind of like macro event factor into how you invest or how you advise your companies?
I mean, yeah, it definitely does. So if you're, for us, we look at, going back to your point on like recession resilience, when you look at what do people tend to spend money on when things aren't going well, right? A lot of vice industries in particular have done quite well. Also, a lot of entertainment just does well, right? Just generally.
Yeah.
And it's because people inherently, when things are going poorly, they don't want to pull away from one of the few things that maybe is bringing them joy in a rough season, right? And so I think this is where I would slot gaming. I wouldn't slot gaming as a vice, but it does share characteristics to a lot of the vice industries on how it's performed as an entertainment property. So that's just largely where I would sit it. When we looked at the last recession, I think the closest comp we can do is, 2008, 2009. Things got really rough, especially in the U.S., but also in the world just largely. A lot of gaming growth remained either flat or slightly up, right? And so that is very encouraging. I think that should be very, very encouraging for startups today. And so, do I think there's a large different strategy I would approach when things are tough in the macro to our startups on like how to market to users? Yeah, there's some probably tweaks, but largely as a whole, like our industry is going to continue growing. There's going to be more people that play video games tomorrow than do today. I would put my entire net worth on that statement, right? And that's why Josh and I are in games. That's why we've done this and dedicated. So you're probably preaching a little bit to the choir. I'm probably preaching to the choir too with you, Joe, launching a startup in this environment. So like that's where I would largely lean. Is this is a great time to be in games, right? Just because almost about any time is a good time to be in games, right? We grow about almost 9%, calculated annual growth rate for the last decade, and we're looking forward, and I think we're going to see just about the same growth rate the next decade. So anyways, that's my starting point. And Josh, I know you got some great comments here too, but that would be my general thought on this.
Yeah, I totally agree. We are in this business because we are optimists about the game industry, but we're not blind optimists. The data support that people are gamers. Everybody has a hardcore gamer in them. I've basically spent my entire career starting during the last recession, introducing people to games, right? Like, the first games that I worked on, things like, Farmville and Mafia Wars and Words with Friends turned people who never would have called themselves gamers into like 3 hours every single day, spreadsheet optimizing, min-max hardcore gamers. And, all of that's a long-winded way of saying, everybody is a gamer. They just haven't found the right game for them yet. And that's why you're continuing to see games adoption and game engagement increasing over time. And so even when I think there's uncertainty in the macro environment, to Jason's point, people flee to happiness and they flee to people. And the beautiful thing about games is it's a really great vessel for both. It's a great vessel for fun, engaging experiences, and it's a great vessel for social interactions. And that's maybe something that isn't talked about as much, but is so key to why the gaming market has exploded over the last decade. Is just really great social experiences, and social experiences are cheap. They're inexpensive, and the value for what you put into them as the end user is really, really high. And so for all of those reasons and everything Jason said, I think we're very optimistic about the games industry.
I think just to also tack on there, just something else that I get questioned a lot about is with games, right? Like oh, Jason, a classic question I've gotten is like, my kid plays too many video games, like how do I prevent that? And I always kind of say look, everything in excess isn't good for you, including working out, right? That's not good for you either. Playing too many games, I'm not here sitting advocating that everyone in the planet should spend 40 hours a week in games, right? That's probably not great for you. But I would much rather hear you tell me that you're spending 20 or 30 hours in gaming than you are watching 20 to 30 hours of Netflix, or of Hulu or consuming passive content. Like, and a lot of people forget this, is that gaming is interactive content. Like, it's a two-way street. You impact the environment, the environment impacts you. And, to Josh's point, it's a social experience for the vast majority of people, right? And that is what we lean into. And that's why I think this is a great thing for people to invest into, but also a great thing for people to invest their time into. It's just, if you're going to pick from the buffet of options with your free time, I would argue that gaming is one of the best ones you could pick. And I really do stand by that, but with obviously the caveat of temperance is always advised with most activities that you indulge in.
Yeah. I was just kind of thinking that one of the other advantages in terms of like the macro environment that I see, and maybe an advantage for you guys being risk on right now, is that anecdotally, I've been hearing from multiple people that a lot of the bigger studios and bigger companies are starting to shift budgets away from new game development into like existing, currently live operating profitable titles. And so from a competitive landscape perspective, because of the current macro economy and where we are right now, if there's less new games being developed by the big guys, and you guys are investing in some of the newer guys, maybe it's actually a good time to be developing new games, so that once you launch, you're actually launching against a competitive landscape that's not going to be as competitive in the future. Okay, I thought we could also just take a moment to think about some of the opportunities, and trying to be a little bit optimistic about the future. And certainly, if I look at my Twitter timeline or my LinkedIn, kind of feed, all this ChatGPT, Lenza, AI, generative AI, all this stuff is like all over the place. And so when you guys think about some of the other opportunities from a gaming perspective, and some of these technologies that could be impacting gaming, what do you guys think? The impact of AI, generative, AI, ChatGPT, all this stuff. What are your thoughts on that in terms of impact to gaming in the future?
Oh man, I'm going to give this to Josh first. I'm going to let him try to answer this one first. Yeah, I'm giving him the hard job. Absolutely.
No, I'm excited to talk about it. I think the rest of tech Twitter have been captivated by ChatGPT, but this fascination with AI's sort of potential impact in the games industry has fascinated me for a lot longer than sort of the latest ChatGPT meme. Having come from game development, look, game development's really hard, and there are massive barriers to entry. It's why companies have to go out and raise so much money to sort of like turn their ideas into reality. And the arms race for scale has only gotten sort of higher and higher over time. Diablo Immortal was a 9-figure budget. Call of Duty Mobile, same deal. And many of the very large games now are very expensive endeavors. Anyway, I'm really excited about AI in a whole number of ways, and we're already seeing actually quite a few entrepreneurs come through with early ideas of how generative AI, can impact the games industry. The first and most obvious, I think, is just reducing the cost of content by a lot. And look, I think there's a real conversation about, what is creativity, what is originality, what is derivative, blah, 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 blah. But, what you, I think, don't realize in game development, if you haven't sort of like been in the trenches and gone through the slogs, is that like a lot of game development content creation is 42 shades of blue, and like, recreating variants of the same textures over and over and over, or, doing, paint overs of like, the same thing over and over and over and over to get it right. And there is obviously amazing creativity in that. But, I think, the optimist view, and the view that I have, and I think our firm has, is that AI has the ability to take very creative people and just multiply and amplify their efforts and their creative minds a whole bunch. And so we love it. And then, just even outside of content creation, there are a whole bunch of areas that, we're looking at the moment, everything from real-time translation to NPCs to, new forms of gameplay. So yeah, the meme exists, but we're genuinely very, very excited.
Yeah, so this is a topic that I've spent a lot of time on because before we launched the firm, I actually worked in research and engineering within the artificial intelligence division of IBM, and so I've spent quite a bit of time under this house and this suite. And, when people say the word AI, it often means something different to a lot of different people, but really underneath it, there's just a lot of housed services. You've got machine learning, which has applications within AI. You've got computer vision. You've got natural language processing. You've got a host of things that you can be talking about. And so for me, I typically like to break it down into, I'm excited about some things and not others. So let me just, kind of come out with a direct statement. I think on a lot of people ask this question, like, do we think we're going to have game developers in 5 years? 100%. We're going to have game developers in 5 years. I am very bullish on human creativity, more so than I am on a machine replacing human creativity. So like that's generally where I slot most of this stuff. And I think this echoes some of Josh's points, which is I would look towards AI being a great assistant. It is a great assistant to a human to deploy and do an action faster, hopefully. But at the end of the day, I'll tell you, as somebody who's worked under the hood for a lot of these types of services, trying to push the boundaries of this technology, it often falls way short of what people hope it does, right? And so, like, level set expectations. I think, investors often have shiny objects and shiny topics, right? If you really want to kind of get what that is, go follow like 100 of the top VC firms. Josh and I will be offended if you don't follow us in that top 100. Follow those 100 people, scrape that in material, and just do kind of like a word finder for keywords across, and you'll start to pick up trends, right? A lot of people were really hopped up on Web3 in 2020, 2021. A lot of that excitement has dissipated, and now it seems that this is the next thing that a lot of people are talking about. And I think the easy thing to do is either one of two things. One is you just go all in on it. You're like 100%, like this is the future. Or the other thing is you say, absolutely, that's total nonsense. And neither one of those are correct, in my opinion. I think you need to approach this with diligence, and I think you need to really evaluate AI for what it is, which is a great assistant. And I am excited about specifically what Josh mentioned, NPCs. I think making those experiences more interactive. Also, I think that we are in a huge technical deficit for game developers to be able to build as much content as we, the users, are demanding. It's almost unfair. And so those are the two areas I'm excited about. But I think that I watched this with, how do I say this? With a little bit of pause, because a lot of companies are going to get funded, and then people are going to realize that they do about 10% of what they hope it does. And that is what I experienced, generally in AI for quite a while. And I'm excited to see what that industry can do for gaming. But I think it's going to be a heck of a lot slower than most people would imagine.
Okay. And so, like, what about some of those trending keywords or other trends or opportunities that people should be aware of? Like, what are some of the things that you guys are seeing that could have potentially a big impact on gaming in the future?
We mentioned dry powder earlier. This is maybe not an opportunity, but more of an observation. We mentioned dry powder earlier, and actually the 800-pound gorilla in the room are very, very large existing companies who are also pouring a lot of money in the games industry that aren't necessarily traditional venture investors. So I used to work with a whole bunch of folks who are now over at Netflix doing a games effort. Amazon is also putting its best foot forward in their games effort. Microsoft just offered a Godfather offer for Activision Blizzard. And you're starting to see the very, very large companies wake up to this realization that A, content is king. B, to Jason's point earlier, that the capital efficiency of games content is just extraordinary, especially compared to other forms of entertainment, and especially movies and TV. And that ultimately that these companies are trying to sort of like monopolize engagement. Engagement, again, back to our earlier conversation, is the ultimate intrinsic. You can do basically anything you want as a business in terms of monetization as long as you monopolize engagement. And so one of the things that I'm thinking about a lot is, what happens when the very, very large players are also, building these massive games efforts. And yeah, you can look back in history and say, well, large companies have tried and failed to do this in the past, but having worked with a lot of these very, very smart people who have been games native for a long time, who are doing this at large companies, I'm taking the effort seriously, and it's something that I think is a net positive for the games industry, and it's just something that I'm thinking about a lot.
Yeah, I think another topic that a lot of people have funded recently, and a lot of people are looking and talking about right now, is just how gaming can impact mental health. So this is something that, we are in a mental health crisis in the United States, and I would probably argue globally. I have more data on the U.S., but the numbers are pretty discouraging if you want to look at them on how many people are suffering from this at an exponential rate, and a lot of that is tied, I think, to technology use. And so it is ironic at times we're thinking about using technology to cure us from an issue that is created by technology at the core. But I do think there's some interesting stuff games can do. Only about 7% of the population will I use the word discipline because I don't have this discipline, but use meditation apps like Calm or Headspace. But you've got quite a bit of the population that doesn't have that discipline. And how do you get them to do it? And a lot of people have thought games is probably the best way. How do you create games to hopefully get people into a similar mindset of calming themselves, slowing them down, and entering a general state of mindfulness, by the way, which was a word I had to look up when I kept reading mindfulness. What is the definition of mindfulness? But just think of it as a healthier state of being. And that is an area that I've thought a lot about, and I hope games can help there. And I think we can. There's some interesting companies going after this problem, and I think we'll see a lot more going after this problem here shortly.
Okay. So I just have one final question, and that's kind of to shift the conversation more towards strategy and operations, and kind of like the original thesis driving this kind of conversation we're having right now is just the dynamic nature of the world that we're living in. So many changes. I think I was just reading something about alternative app stores now, right, for Apple, and there's just so much going on. And I couldn't imagine, like, even in my business right now, like I have to try to understand where kind of like the US dollar to INR conversion rates are happening, because we're living in a more global world. And, I had a friend who had to move his company out of Russia, and there's like all sorts of things happening. And so, like, if you were to think about some of when you're thinking about gaming companies operating today and thinking about some of the most strategic or operational I guess, bits of advice that you would call out that they should be thinking about, what would some of those things be?
I would probably say, if we're first, again, highlighting the fundraising comment, like try to not have to fundraise until Q1 of 2025. Like if you're going to do that, my goodness, you will be in such a good spot. So think through that. Do not plan to start raising capital in November because very few deals get done between Thanksgiving and Christmas, especially in the West. So really plan that out. If you need to raise if you really need money in Q4, start raising in Q2 of 2024. So just kind of a tactful thing. Things will still take longer than they did before. That's one. Operationally, this isn't fun advice, but I think it's necessary advice. Look through your staff and determine who do you need and who do you want there. There's a lot of wants that you cannot have right now, and that's unfortunate. So that is an operator question that I've asked of a lot of our operators, is just who do we need and who do you just really want around, and you need to get your burn to a spot where you can survive, where you're not having to raise in the peak of the downward trend, which is probably in Q2, Q3 of next year, right? So that's my general advice, operationally, more around capital raising. And then, I would tell you, like, figure out who on your team right now, who do you need to keep happy and keep them happy, right? And so, like, a lot of questions we've gotten recently is like, hey, we have a certain amount of money as a pool of capital for salaries, for bonuses. You need to prioritize who's the game changer for you, right? That's what you need to prioritize. I think the era of, super employee friendly across the board is coming to a close, right? When things get tough, people have to make tough decisions. And that is okay. Like when the going gets tough, the tough get going. And I think that to Josh's point, we're going to see a lot of diamonds kind of emerge here in startups. So those are my general piece of advice. It's more around payment of employees and bonus pools and then capital raising.
Awesome.
I think those are really great. And it maybe highlights, one point, which is, really great founders and CEOs are made during hard times. And the reality is actually that quite a few founders who raised in the last cycle or created their teams in the last cycle, first-time founders, this is sort of the first time they're going through like the really hard macro times. And so it is a massive shift in mentality to sort of usher your teams, not just structurally with raising capital and having the right cost structure and managing burn and all of the things, but also spiritually, right? Like, what does it mean to be a really great wartime leader? What does it mean to keep talent, like top talent around without necessarily paying them more? These are the times where really, really great CEOs are sort of made and sort of honed. And so to the extent that you're a founder or CEO going through this, think about too what kind of leader you want to be, and make sure that you're consistently communicating with your teams. Really be out there. This is the time where it's actually probably more important for you to be spending more time with the team than out raising. And luckily for you or unluckily, there's less activity there. So spend more times with your team and spend more times in the product. And this is sort of where us as investors betting on really great founders, this is where that philosophy in investing really comes back and generates great returns.
All right, gentlemen, thank you very much for your time. Maybe we could just actually end it with, if people do want to reach out to you, can they try to reach out to you? How would they do that, Jason?
100%. Yes, please find me on LinkedIn or Twitter. It is not that hard to find me.
I'll
Jason,
leave links in the show notes. So
that would be great. I'm always open to chat about some crazy stuff in gaming. So please do ping us. And those are probably the two best avenues for us.
Josh?
Yeah, same here. LinkedIn, Twitter, @Josh Lu. I'm new to Twitter, so be gentle, but would love to have a conversation.
Awesome.
Oh man, Josh, we got to do some Twitter threads together. Then this will be fun. We'll do this.
Let's do it.
It'll be fun. All right. Thanks, Joe.
Great.
Appreciate it.
Yeah, thank you very
See you
much,
guys.
guys. And for the audience, catch you next time. Thanks, everybody.
Bye.